Good morning, boys and girls. Hello, kids. This is Uncle Pete, and you are on Uncle Pete's Wall Street channel. All right, today's topic is I know this is the fourth video, right? All my videos are labeled video one, video two, video three. Here's four. We're taking this in succession. I want to teach you newbies step by step what all this is. So today's topic is what is a stock? What is a bond? What is a mutual fund? And what is an exchange traded fund? Um, but it's always called an ETF. You'll hear people say ETF. It just means exchange traded fund. And I'll explain everything about this stuff. And we're going to talk about what is a broker dealer? What is a stock exchange? Okay. All right. So, what is a stock? A stock, if you own a stock of a company, now we're talking about what's referred to as publicly traded companies. A publicly traded company means that they've issued stock, right, to the public to buy. They've listed it on an exchange, either the New York Stock Exchange or the NASDAQ Stock Exchange or the Toronto Stock Exchange, wherever. Okay. It's a company that has sold shares, sold ownership to their company to the general public. Okay, so if you own a share of stock, you are a part owner of the company. Okay, so let's look. We have Apple here. And over here where my cursor is, you have the oh boy, the ticker symbol of Apple, which is AAPL. Okay, the ticker symbol is how you communicate with your broker. And I'm going to explain what a broker is momentarily. Just stick with me. So that's the ticker symbol of the Apple Incorporated company. AAPL is the ticker. So move over to the right here, okay, where it says share profile. And under that, now, by the way, this is Charles Schwab. Charles Schwab is a broker dealer. Okay, I have an account with Charles Schwab. That's where I do some of my trading. Okay, so I'm on their website and I pulled up Apple Corporation under their research tools. Okay, it tells me everything I need to know about Apple. Here's the company profile. Apple designs, manufactures, and markets smartphones, etc. All right, so down here on the share profile, we have the market cap, which is short for market capital appreciation, which is nothing more than the shares outstanding. See here where it says shares outstanding, 15.04 billion shares that are outstanding and available to the public and owned by the public, right? So the market cap is nothing more than the shares outstanding times, to this left here, the current market price, which in this case, where are we? We're February 7th, 2025. We're in the middle of the trading session. It's 2:51 p.m. on Eastern time. Apple is currently trading at $228.22. Okay? So here we have the market cap, shares outstanding times the current price of the stock. Apple is currently worth $3.51 trillion according to the market. Okay? So, if you were to buy 100 shares of Apple, right, it would cost you over $22,800. You would be a part owner of the company. A very small owner of the company based on 15 billion shares outstanding, you would own 0.000000 or whatever of the company. And with that ownership comes voting rights, right? You'd be able to vote on whatever the company would need you to vote on at the annual stockholders meeting. But let's forget about all that. Let's just stick to this. So a stock is you own a piece of the company. When a company needs to raise money to help pay for expenses, such as hiring more people or expanding into new markets or building a new warehouse or building a new facility um, to build their products, right? They need money, so they might issue stock. And the value of your stock will go up and down based on how the company performs and what the overall traders in the market from big institutions like mutual funds, which we'll talk about in a minute, um, and the public at large, what they think the stock is worth. It trades all day long from 9:30 a.m. Eastern time when the stock market opens till 4 o'clock p.m. Eastern time when the stock market closes. It trades all day long. Okay, so when you own a stock, you are a part owner of the business. Okay. So let's talk about bonds. Bonds are also known as fixed income investments, and they're debt investments. So sometimes a company wants to raise money. They don't want to issue stock. They want to issue bonds. What are bonds? They're creating bonds, right? And that represents money that is loaned to companies, to individuals, or even to governments. When you purchase a bond, you are loaning money to the company that is issuing bonds, and you're paid interest based on the value of that company. So, a company that's not doing so well, in order to entice you to buy their bonds, right, they have to pay a higher interest rate, right? Whereas when the federal government issues bonds, and I talked about that in my previous videos, because the federal government, because those bonds are backed by the full faith and credit of the U.S. government, they are essentially the safest bonds because they're safer than a corporate bond issued by a company. They can get away with paying less interest because they're theoretically not as risky as a company's bonds. Also, bonds that have a shorter maturity, say for instance, a bond that matures in a year, is not as risky as a bond that matures in 30 years. Why? Because if you had a bond that matures in 30 years, you versus a bond that matures in 1 year, you have a bond that has 30 years of risk of, I don't know, going out of business, defaulting, whatever. Okay? So the longer time frame the bond is, the more risk, so the higher interest rate. In addition to paying interest, when the bond matures, whether it's 3 months, 6 months, a year, 2 years, 5 years, 10 years, 20 years, 30 years, when the bond matures, the bond issuer, whether it's a government or a corporation, and sometimes even uh, towns issue bonds, municipalities have municipal bonds. When that bond matures, they have to pay back the principal to the bondholder. So, in addition to paying interest at regular intervals, they have to pay back the principal. Okay. Now, mutual funds. Let's look at mutual funds. What is a mutual fund? A mutual fund is a basket of investments chosen and managed by professional mutual fund managers. With a mutual fund, you don't directly own individual stocks or bonds or gold or silver or whatever. You own shares of the fund, which owns the individual securities. So let's look at the one on the screen. This is a mutual fund that I've owned for I don't know how long, forever, right? This is a Vanguard, and I've talked about this before. S&P 500 index fund, right? And this is not a managed fund. This is an index fund. And because it's an index fund, it does not have a host of equity analysts or stock analysts looking into companies and deciding whether or not they're good investments or not. This is an index fund. It automatically always owns whatever 500 companies make up the Vanguard the Standard & Poor's 500 index. All right. So I buy this one fund, which is currently trading at $561.88. I buy this one fund and I own 500 different companies. And for that, I pay a very low net expense ratio. You see this at 0.04%, right? Because this is not a managed fund. This is not an actively managed fund. Whatever 500 stocks make up the index, that's the 500 stocks the fund buys. Now, it has an algorithm that figures out how much of each company to buy, right? But it doesn't have all the stock analysts that they have to pay for. And what do stock analysts do? Stock analysts have a particular industry that they are supposedly experts in. Like some stock analysts are experts in retail companies. Some stock analysts are experts in energy companies. Some are experts in high tech, right? And they send out these equity analysts. They get on planes and they fly to these companies and they meet the management and they talk to them and they look through their plants and they research the company's financial statements and they figure out how good is this company versus its competition, and you have to pay those people. This fund does not have those people. That's why the expense ratio is 0.04. Let's look at an actively managed fund, right? Here is the Fidelity Advisor Small Cap Growth Fund. What is a small cap? That means there's smaller than a large capitalization company, right? And now this is a fund rather, that has a whole bunch of equity analysts, stock analysts that have to pore over financial statements of small cap companies, small capitalization companies, right? Visit their management, examine their competition, and decide and advise the manager of the fund whether they think it's a good investment or not. And for that, you have to pay all those people. You could see the net expense ratio is 0.86. It's way, way higher than the expense ratio of the index fund that I showed you, which was 0.04. So this fund has to do so much better in returns than the index fund because of this expense ratio. They're already at a disadvantage because they have to pay all these people to do, right, what this fund does for 0.04% instead of 0.86%. Okay. Now, this fund has some expenses. It has administrators, right? An administration team that has to answer the phones and answer emails and pay out dividends and all that stuff. But it's not nearly as bad as this Fidelity Fund, which has an expense ratio of 0.86. That's a huge chunk of your money that you invest that's going to pay for all these people to do their work versus the net expense ratio coming out of your investment going towards this fund. And that's one of the reasons why I've invested a lot of my money in an index fund, because it's very hard for a managed fund to beat the market. This fund represents essentially the market. All right. So this is a mutual fund. And as I said, there's two types essentially. Now, there's a, an index fund like this or a managed fund like the Fidelity Fund I showed you. But there's all kinds of there's all kinds of funds out there. There's funds that invest in precious metals. There's funds that invest in bonds. There's funds that are called balance funds, which invest in stocks and bonds. There's thousands and thousands of funds out there. And that's why sometimes people are very confused about where to put their money. There's so much out there to invest in. But this channel is devoted to you just to start, just to begin to understand, right? How this all works, some of the terminology, and some of the things you don't need to know, but all this crazy stuff. And just get your money working and start yourself slowly on an education, right? On how this all works. So that in time, maybe you want to make some changes. Maybe you want to do some different things, right? We'll have to see. You may want to change your investments up 2 years, 3 years after you start investing because now you're more educated. And that's what this channel is. All right. And I'm going to help you find the books that you are going to understand. Okay. I'm not going to recommend books that are filled with a bunch of crazy Wall Street jargon that you don't understand. There's plenty of books out there from great investors who write for an audience that doesn't know anything and explains it. And that's really what my channel is. So, all right. So we did stocks, we did bonds, we did mutual funds. Let's talk about exchange traded funds. So before I get to that, mutual funds, you will notice, see the ticker symbol for this mutual fund up here? VFIAX. All mutual funds end with an X. Here's the Fidelity Advisor Small Cap Growth Fund, FIDGX. That's how you know it's a mutual fund. Okay? So, here is the Vanguard S&P 500 Index Fund, right? But Vanguard also has an ETF of the same thing, Vanguard S&P 500. All right. What's the difference between an exchange traded fund, an ETF, and a mutual fund? A mutual fund, if you want to buy or sell a mutual fund, it only happens one time a day. At the end of the day, all these stocks or all the financial instruments that make up that fund, the closing prices are added up and it's all figured out what the price of the fund is going to be at the end of the day. So really, if you want to buy or sell a mutual fund, you have to get your order into your broker. And I'm going to talk about what a broker is. Hang on. You have to get your order into your broker probably around 3:30 to make sure your trade goes off. Because mutual funds trade once a day at the end of the day at the NAV, which is the net asset value. And all the net asset value is all the financial instruments that are in that fund. The closing prices are all added up, multiplied times how many shares of each or how many contracts or whatever the financial instrument is. It's all added up and it's One single price is here for the fund. Contrast, an ETF, an exchange traded fund. This is the Vanguard S&P 500 exchange traded fund, ticker symbol VOO. It's the same thing as the S&P 500 for Vanguard. The only difference is this is an exchange traded fund. What does that mean? It means all it means is it trades all day long like a stock. It trades from 9:30 Eastern Time AM when the market opens to 4 p.m. Eastern Time when the market closes. The mutual fund trades once a day at the end of the day. An ETF, exchange traded fund, trades all day long, right? So you can day trade this if you want. You can buy and sell it, buy and sell it, buy and sell it, buy and sell it all day long. Or you can just buy it once or sell it once. That's the only difference. The other minor differences, sometimes in some certain ETFs, the expense ratio for an ETF might be slightly lower than a mutual fund. Okay, now that we got done with that, let's talk about what an exchange is. Okay? What is a stock exchange? So we all know the New York Stock Exchange, right? The New York Stock Exchange, which has traditionally been known to trade stocks of more well-known companies, and the NASDAQ, right, has been known to traditionally facilitate the trades of less well-known companies. Okay, like technology companies. So let's talk about what the exchange is. And if you're having um, if you're having a hard time figuring out what an exchange, understanding what a stock exchange is, a stock exchange, look at it this way: a stock exchange is nothing more than a grocery store. When you go into a grocery store, let's say a Wegmans or a ShopRite or Publix. I think they have those down in the South, or even the Piggly Wiggly. They have a Piggly Wiggly down in the South. These are big grocery stores, right? What do they have in there? They have thousands of different items from you that you can buy from people who are selling those items, right? And who are you? You are the potential buyer of those items. Okay. So a stock exchange, and let's pretend that you could go in there, right? If you were just some person off the street that you could sell some items to if you wanted, right? A stock exchange is nothing more than a meeting place for people to buy and sell securities. That's all it is. It's a grocery store of securities. Okay? So you can go in a store, you can buy your Fruit Loops or your Lucky Charms or your favorite box of cookies, right? Sold to you by someone who wants to sell them. Keebler, Nabisco, right? That's all a stock exchange is. It's a big grocery store for stocks, bonds, mutual funds, ETFs. That's all it is. All right. Now, what is a broker dealer? So years ago, people, if you wanted to buy and sell stocks, you needed a broker because your broker had access to the exchange. So you either walked into a brokerage firm, you know, before the advent of telephones, right? If you didn't have a telephone, you you walked into your brokerage firm, You said, I want to buy 5 shares of General Electric. Yeah, and up until a bunch of years ago, General Electric was one of the last original companies that made up the Dow Jones Industrial Average until they were thrown out and replaced by something else. I forget what replaced them. Right? So you walked into your brokerage, or if you had a phone, maybe you call up your stockbroker, right? And you told your stockbroker what you wanted to buy or sell. You had a brokerage account, all right? And there were times, I don't know, in the 80s where guys would go to their cocktail parties and say, hey, I spoke to my stockbroker today, and he's pretty hot on, I don't know, Blue Sky Airlines, whatever, right? To use a reference from Wall Street, the movie. Um, and trying to impress people at the cocktail party. But all they ended up doing was sounding pretentious and stupid. These days, I don't even know if there are any stockbrokers. Years ago they kind of morphed into financial planners because the uh, the average person had access through computers to the markets. They didn't need a stockbroker, right? Unless they wanted advice. And in 1975, right, the uh, the the SEC mandated that brokerage firms could now negotiate their commissions instead of charging a fixed commission. So you had companies created that competed. They had to compete now with commissions. That was in 1975. All right. And you had discount brokers like Charles Schwab and Muriel Siebert, who died a bunch of years ago, but she was the first woman who had a seat on the New York Stock Exchange. And they were known as discount brokers. They charged less commissions to facilitate trades for their customers because of deregulation of stock brokerage commissions. All right. So a brokerage firm is nothing more than a firm that gives you access to the exchange. All right. That's it. And the term broker dealer, right? A broker executes orders on behalf of its clients and can be either like a full service broker that charges you more because they give you more services, or a discount broker that's just there to execute your trades. You don't need any advice on what to buy or sell, right? But a dealer facilitates trades on behalf of itself, right? And that's it. So that's it as far as what is the difference between a broker dealer. Okay, they just give you access to the exchanges. All right. So I hope you I hope you got a lot out of this video. I hope it answered a lot of your questions. If you have more questions, put them in the um whatever they call it. What do they call it? Put your questions in the comments section. I'm drawing a blank here. Put your comments in the comments section, okay, and I'll try and answer them. All right. Thanks a lot for listening. This is Uncle Pete, and you've been listening to Uncle Pete's Wall Street.